Okay, let's unpack this. We all think about building wealth, maybe even serious wealth. But what's the real goal?
Well, yeah, making it is one thing. Making it last. That's the ultimate test, isn't it? It's about legacy.
Exactly. And today we're doing a deep dive into that very question, looking at how fortunes survive or don't. We've got these two towering figures from American history.
Right, the central conflict here is fascinating. Why did one colossal fortune basically, evaporate in just 3 generations, while another is still going strong after 6?
And we're talking Cornelius Vanderbilt versus John D. Rockefeller.
Yeah.
Titans of industry.
Yeah.
Vanderbilt, a Commodore. He died back in 1877 with, over $100 million?
Which is just staggering in today's money, like north of $200 billion, a truly incredible sum.
And what did he do? Pretty much what you expect, right? Left the vast majority, like 95%, to his son, William Henry.
Yep. And look, William Henry actually bubbled it initially, so credit where it's due, but that was kind of the high watermark. After him, the heirs seemed almost laser focused on proving that old saying. Shirt sleeves to shirt sleeves in 3 generations.
The spending was just legendary, wasn't it? Those Vanderbilt mansions, 10 of them in Manhattan alone, plus the breakers in Newport, symbols of the Gilded Age.
Absolute symbols. But they were monuments built by essentially draining the principal. The money wasn't treated like a perpetual engine, more like a giant slush fund.
And the result was swift.
Yeah.
And pretty brutal. By 1947, so 70 years after the Commodore died, all 10 Manhattan mansions were gone. Just torn down.
Gone. His last words were supposedly, keep the money together, utterly ignored. It just vanished.
Okay, so that's the cautionary tale. Now contrast that with John D. Rockefeller, even bigger fortune potentially.
Yeah.
Estimates go up to maybe $341 billion equivalent today.
A mind-boggling amount. But the approach to legacy, totally different. That's the key pivot point here.
How so?
Well, Rockefeller's son, Jr., didn't just get a pile of cash. He inherited a system, a methodology. He made sure the wealth stayed centralized. He set up these tightly controlled trusts for the kids.
Ah, the trusts. And they were managed by something called the family office, right?
Exactly, that family office structure. And that's why we're still talking about the Rockefellers today, 6 generations on. The fortune's still estimated, over $10 billion?
Still substantial. And it supports, 150 descendants.
Providing opportunity, liquidity. It wasn't just handed over for spending, it was structured using legal tools, the trusts, to shield the principal from taxes, lawsuits, and maybe most importantly, from heirs who might just blow it all.
Like the Vanderbilts did.
Precisely.
Yeah.
So that centralization, the family office, that's the structural difference. But, that structure needed a specific financial engine, something resilient, protected, a core reservoir for the wealth.
Okay, and that leads us to the heart of the strategy, what our sources call the Rockefeller method. And at its core is this tool they've identified as cash flow insurance, or CFI.
Right. And this forces a big mental shift. Most of us are taught finance through a lens of, scarcity, right? Save your way rich, pinch pennies.
Yeah, stick it in a savings account.
And get 0.05% interest today, maybe 1% if you're lucky. You're actually losing purchasing power, and your capital just sits there eroding. It's not productive.
Okay, let's just tackle this head on, though. Cash flow insurance. That sounds like life insurance. And immediately people think term insurance, or they hear those finance gurus yelling, buy term and invest the difference.
Totally. And look, that advice has its place maybe, but CFI is something else entirely. It's a very specific, customized setup of permanent whole life insurance. The goal is to structure it to maximize the cash value growth and use it like your own personal or family bank.
Okay.
And here's the kicker, the really surprising part. The big, safe institutions. Banks, they do this too.
Wait, banks use life insurance?
Yeah, they hold massive amounts of life insurance, often called BOI bank-owned life insurance as part of their Tier 1 capital reserves. Why? Because it's incredibly stable, offers huge tax advantages, and earns dividends. CFI is basically saying, cut out the middleman. Do what the banks do, but for yourself.
Okay, that reframes it significantly.
Yeah.
So what are the key features that make this CFI structure work?
There are a few critical things. First, guaranteed growth. Unlike the stock market, there's typically a contractually guaranteed minimum interest rate, often around 4%. That's your floor.
4% guaranteed plus potential dividends on top.
Exactly. Second, it's incredibly tax efficient. The cash value inside the policy grows tax-deferred, potentially tax-free, the death benefit payout, income tax-free, and policy loans, also tax-free.
Hold on, tax-free loans, how does that work? If I take money out isn't that income?
It's structured as a loan against your cash value, not a withdrawal from it. So the IRS doesn't classify it as taxable income. And even if you do take a withdrawal later, it's first in, first out, meaning you get your premium payments back first, tax-free, before you touch any taxable gains. That kind of tax certainty is, well, pretty rare.
Okay, guarantees, tax efficiency.
Yeah.
What else? Protection must be a big part of it for legacy planning.
Absolutely vital, that cash value. In most states, something like 40 out of 50, it's shielded from lawsuits, creditors, even bankruptcy. It's basically locked down, protected. That's the kind of fortress the Rockefellers were building.
But you said earlier the setup is crucial. You can't just buy any old whole life policy off the shelf. You mentioned high commissions, slow growth.
No, definitely not. That's where the specialization comes in. The key mechanism is using something called paid-up additions, or PUAs. Think of it like this. Normally, a big chunk of your premium pays for the death benefit cost and the agent's commission. With PUAs, you're essentially overfunding the policy. You're buying small, fully paid-up blocks of additional insurance.
And why is that better? What does that do?
It dramatically accelerates the cash value growth. That extra PUA money goes almost entirely into your cash value, not commissions, and starts earning interest and dividends immediately. And critically, the sources stress this PUA strategy can slash the agent's commission by like 50 to 70%.
50 to 70% less commission.
Yeah, it flips the whole policy design.
Yeah.
Instead of maximizing the commission, it's designed to maximize your liquid growing capital from day one.
Okay, that's a massive difference. Now let's get into maybe the most powerful but also maybe misunderstood aspect, this idea of uninterrupted compounding.
This is really the engine of the whole thing. See, normally, if you need cash, you sell a stock, you pull money from savings. What happens?
You stop earning on that money. The compounding breaks.
Exactly, you interrupt it. With a properly structured CFI policy loan, you're borrowing against the cash value. The insurance company gives you a loan using your cash value as collateral.
So the money inside the policy, it just stays there.
It stays there, fully collateralized, still earning its guaranteed interest, still getting potential dividends, compounding away completely uninterrupted, even while you're using the loan proceeds for something else.
That's counterintuitive. So
Yeah.
you get to use the money and it keeps growing.
Precisely. It's like having your cake and eating it too, financially speaking. This creates what they call the opportunity cost advantage. Think about it. Buy something with cash, you lose the growth on that cash. Finance it through a bank, you pay interest to the bank.
Or you lose that interest.
With CFI, you take a policy loan. Yes, there's loan interest, often comparable to bank rates, but where does that interest go?
Back to the insurance company, which, wait. If the company is mutually owned, or even if it's just fueling their returns, it indirectly benefits you as a policyholder. Right. Or at least keeps your underlying asset growing. You're paying interest, essentially, to support your own system.
You've got it. You're recapturing the financing costs within your own financial ecosystem. Let's take a practical example. Say you've got, I don't know, a $10,000 credit card balance at 17%. Brutal.
Yeah, that's killer interest.
Okay, you take a tax-free loan from your CFI policy, maybe the loan rate is 5 or 6%. You pay off the credit card instantly. What just happened?
Well, you stopped bleeding 17% interest to the credit card company.
Right, you eliminated that leak. You're now paying maybe 6% back on the policy loan, which supports the insurance company backing your policy's guarantees and dividends. Meanwhile, the full $10,000 inside your policy is still compounding away uninterrupted. You've basically recaptured that financing function.
So it becomes this private capital source, a war chest.
Exactly. It's liquid, it's accessible, you don't need bank approval, no credit checks, no lengthy applications. Need cash, fast for a business opportunity, inventory discount, down payment. The loans are private, flexible repayment. It gives you incredible speed and control. We saw examples of people snapping up wholesale inventory, buying equipment, even real estate, because they had immediate access to capital.
This really shifts the focus, doesn't it?
Yeah.
It's less about chasing fractions of a percent in higher returns and more about plugging the leaks in your financial system.
That's where the data gets really stark.
Yeah.
We're obsessed with getting, say, an 8% return instead of 7%. But the bigger enemy is financial erosion.
Erosion, what do you mean?
The research laid out this calculation. It's pretty shocking. Take someone with a hypothetical earning potential over 30 years of, say, $12.9 million. Pretty successful career.
Okay.
By the end of those 30 years, after taxes, debt payments, lifestyle costs, how much do you think is typically left in actual personal savings?
I don't know, a few million.
Try $194,000.
What? Out of nearly $13 million? That can't be right. Where does it all go?
It leaks out. About 40% on average goes to taxes, income, capital gains, you name it. Then a massive 35% goes to debt service, paying interest on mortgages, cars, credit cards to banks and lenders.
Okay, that's 75% already gone to taxes and debt.
Right. And the remaining 23.5% or so covers lifestyle, leaving that tiny sliver, the $194K, as actual saved capital, its financial death by 1,000 cuts.
Wow. So the power of CFI then is attacking those two biggest drains, taxes and debt interest.
Exactly. By using the tax advantages of CFI and its private banking function to recapture interest you'd otherwise pay out, you dramatically reduce those leaks. The calculation showed that just by trimming the tax burden slightly, say by 4%, and cutting external interest payments from 35% down to 20%.
Which you do by financing things through your policy instead of banks.
Precisely. That potential savings number jumps from $194,000 to over $2.6 million.
Just by being more efficient, without needing higher investment returns or taking more risk.
Just by stopping the bleeding. It's about efficiency and control, not just chasing yield.
Okay, this makes sense logically, but it flies in the face of so much mainstream advice. We have to talk about the critics. Dave Ramsey, Suze Orman, they preach buy term and invest the difference. BTID.
Right, and look, the BTID argument sounds simple, but it often ignores reality. To truly replicate the combined benefits of a well-structured CFI policy, the guarantees, the tax-free growth, the tax-free loans, the creditor protection, and the death benefit you'd need to consistently earn something like 9.8% per year on your investments.
9.8%.
Net. After all fees, after all taxes, year in, year out for decades, how many people actually achieve that?
Almost nobody, especially considering taxes and fees on typical investments. Plus, BTID completely ignores the living benefits, right? The liquidity, the protection. It just focuses on death benefit versus cost.
Exactly. It misses the point that CFI is a living asset, a financial tool you use throughout your life. And philosophically, it's different too. The standard advice often revolves around painful budgeting, scarcity.
Cut up your credit cards.
Yeah, which the sources argue kind of kills financial velocity in exchange. The Rockefeller approach, this CFI approach, is about efficiency. Value-based spending, yes, but primarily about making your money work harder and smarter, increasing the flow, not just restricting it.
Okay, let's circle back to the Rockefeller legacy itself. It wasn't just the financial tool, it was the structure around it, the trust, the family office.
That governance is key. The trust acts like the permanent family bank. Descendants don't just get handed millions. They have to petition a board of trustees for loans, for education, for starting a business, for philanthropy. The principle is meant to stay intact perpetually.
And how does the CFI policy fit into that structure?
It acts as the ultimate backstop. The death benefit of the CFI policies owned by the trust serves as, essentially, asset insurance. If a descendant gets a loan and for whatever reason can't pay it back, or maybe the trust needs liquidity, the eventual tax-free death benefit replenishes the capital.
So it ensures the family bank doesn't get depleted by bad loans or unforeseen needs. It guarantees the principal survives long-term, avoiding that Vanderbilt scenario.
Exactly. It protects the core capital. But Rockefeller knew wealth alone wasn't enough. You have to pass on the values, the intellectual legacy, the stewardship mindset.
This was maybe the most surprising part for me. They didn't just leave legal documents. They left detailed philosophical guides.
Extraordinary detail. We're talking about things like a statement of purpose, sometimes dozens of pages long, like the 51-page example mentioned. These documents guide the trustees, guide the heirs, laying out the family philosophy on wealth, character, responsibility, contribution.
So it's not just about managing money, it's about managing character, preventing an entitlement.
It's the ultimate safeguard against the potential corrosive effects of inherited wealth. The structure incentivizes productivity and responsibility rather than just enabling a life of leisure.
So, wrapping this up, what's the big takeaway for you listening to this? At the end of the day, this CFI strategy, this Rockefeller method, it creates something powerful.
It creates what the sources call the economic value of certainty. Knowing your foundation is secure, liquid, guaranteed to grow no matter what the markets do, that frees you up.
Frees you up how?
It allows you to take calculated risks elsewhere, in your business and other investments, because your core capital, your family's financial bedrock, is protected and growing predictably. It removes that background financial anxiety.
That homeowner's insurance analogy you mentioned earlier really hits this home.
Yeah, think about it. If you have $1 million house and no insurance, you mentally, or maybe even literally, have to keep $1 million sitting somewhere safe but stagnant, right, just in case the house burns down. That money's not working for you.
It's dead money, losing to inflation.
But if you buy homeowners insurance for, say, $2,500 a year, what happens? You've transferred the risk. Now that $1 million is freed up, invest it, even conservatively, at 5%. That's $50,000 a year in earnings. Subtract the insurance cost, you're still netting $47,500.
Wow. So the insurance didn't just protect you. It unlocked nearly $50,000 a year in productivity from capital that was otherwise tied up.
That's the power of certainty. That's what CFI aims to do for your overall financial life. It secures the foundation so the rest of your capital can be deployed productively.
So here's maybe the final provocative thought. Most of us spend our whole lives trying to build a net worth, fighting market swings, taxes, inflation, all that erosion we talked about.
Right, decades of effort and risk.
The Rockefeller method, using CFI as its engine, suggests you can essentially buy your future net worth, or at least a significant guaranteed portion of it, from day one through that death benefit.
Yeah.
You ensure your legacy immediately.
You create that certainty today. You implement the same principles of efficiency, guarantees, tax advantages, and liquidity that the wealthiest families and institutions have used for generations. Why wait decades, risking everything, to secure what you could potentially lock in now?
Stop gambling and start guaranteeing. That seems to be the core message.